What is going on, your average investor? Today we're going to be talking a little bit about the bond market, what they are, how to invest in them, how to take advantage of them, what they do during inflationary periods, what they do during time of recession, and what an average investor can think of or how to use these instruments to diversify their portfolio. If you haven't already subscribed, please do so. We're trying to monetize the channel. That way we can run through a couple additional handouts, giveaways, and things where people can take advantage of their long-standing subscription with us, and we can help them out. So first, what is a bond? How to take advantage of them? Well, short answers are bonds tend to be less volatile than stocks, and they often perform better during a recession than other financial assets. But why? So we need to look at what a bond is. And the best way to think of a bond and why they're attractive is bonds are typically loans from investors to corporations and governments, and they provide regular cash flow and a decreased chance of losing the initial investment. But why? Well, are they really safe during a recession is also the second question we typically get. And bonds do tend to be less volatile than stocks and often perform better during a recession than other financial assets. But they do come with their own set of risks, and we'll be talking about those shortly. So first, we want to talk a little bit more about what a bond is and how investors can use these in their portfolio to diversify. So the easiest way to think of a bond is they're like a loan. They're a simple style of loan. They are a security issued by a corporation or a government as a way of raising money. So you run your own business. You say, hey, we really need some money. You have two different options here. You could sell shares of your business. You could say, hey, I'm going to give you some of the stock, some underlying equity in the business, which means you would partake in both the losses of the business, but also the gains of the future business. Or you can issue a bond, which basically states that, hey, I'm going to give you a lump sum of cash up front, $5,000, whatever this is all fictitious. None of these numbers are in actuality. This is for example purposes only. I'm going to give you $5,000 with the contingency that the company, myself, is going to pay you back that $5,000 plus interest on the underlying investment. So it's essentially a loan. So the investor lends the bond issuer a certain amount of money. The bond issuer then makes interest payments to the investor during the term of the bond or the duration of the bond, and he repays the face value of the bond when it matures. So you're going to also get your original investment back. So bonds come in many different forms, many different variations. I put some of the different types of bonds up here so you guys can see that there's U.S. Treasury bonds, governmental agency bonds, muni bonds or municipal bonds, as well as corporate bonds, which come primarily from corporate structures or entities. All have different tax implications. All are different styles of bonds. And we're going to get into this over the course of the next few days. We will be doing kind of a mini series on what bonds are, how we take advantage of these, what you can do in your portfolio to diversify, but to also gain some advantage of these styles of bonds. So, first thing I think it's worth talking about is the various styles. So you have U.S. Treasury bonds. These are direct debt obligations backed by the full faith and the credit of the U.S. government. One thing to think about, and in courses and in classes, they will always tell you this: if something is backed by the U.S. government, the full, quote, full faith and credit of the U.S. government, it is very, very, very unlikely that they will default on the loan. And that is something very important to consider. As an investor, you want to make sure that your cash is protected, that you have no issue with it, and ultimately that you will be getting your initial investment back. Think of, hey, you have a friend that says, I want you to invest in my business, and you give him a lump sum of cash. Is the business actually going to be able to pay you back? Well, if it's backed by the full faith and the credit of the United States government, you have a very strong likelihood that they will be paying that out. I mean, it's like, you can't in finance say anything is guaranteed, but it's pretty darn close. Because what will end up happening is, let's say they were going to default on something, they'll just print more cash and you'll get your original investment back. The other nice part is there is high liquidity. And this is important in the bond market because if you want to trade bonds, if you want to be investing and then getting in and out of these bonds, you have to make sure that someone's going to be there to pick up the bond when it comes time for the bond to mature. So taxability on these, they're federally taxed. They're generally exempt from state tax. And that's a huge play here because state tax on the variability of tax rates for individuals does change pretty significantly depending on what state you live in. So in the United States, for instance, California has a higher tax rate. New York, some of these other states have higher tax rates, which would imply or implicate that you're going to be paying more on that. However, because they are a federal bond or a U.S. Treasury bond or note, you would not. So this is part one of many, and I would love to get your guys' opinions. I will be going into on future videos the different style of ETFs that you could get into with bonds, which ones are going to take more tax advantage, which ones will have higher return, which ones give you the potential for growth. And now growth is a little different than its traditional equity, which rises as the stock rises or falls when the stock falls. Bond growth changes on a variety of different factors because the easiest way to think about bonds, in for the most part, this is not applicable to all bonds, but your standard bond, if someone says, hey, bond, this is usually what they're talking about, is a bond has a set payback, almost like a dividend, over a period of time, over a duration of time. And we will be talking a little bit later about yield to maturity, what the yield to maturity is, or how you redeem a bond and the book yield or book value of it. We'll be getting into all those later. So let us know in the comments below, do you own any bonds? What kind of bonds do you want to learn more about? Tax exempt or muni bonds, corporate bonds, which pay higher, but there's a higher chance of default or less liquidity, and more than happy to make videos. Remember, if you haven't subscribed, please do such. Help us monetize the channel. We'd love to do a giveaway and help you put some of that money into something like a bond to diversify your portfolio. Have a great day.